If you are watching silver today and wondering whether something much bigger is happening, then you need to pay attention, because an 11% surge in silver is not the kind of move that appears out of nowhere. A move of that size tells us that traders are repricing risk. It tells us that demand is changing, and it tells us that the relationship between precious metals and monetary policy may be entering a very different phase. Gold is moving too, but silver has something gold does not have. Silver sits at the intersection of monetary demand and industrial demand. That makes its moves faster and often more violent. The big question now is not simply why silver moved higher. The real question is what happens if the Federal Reserve cannot respond the way markets expect. Right now, the Fed is facing a difficult balance between inflation and economic weakness. That is why this silver move deserves your attention. Before we go any further, there is something important to understand about the current market. Precious metals are not moving in a vacuum. Gold and silver are reacting to interest rate expectations. They are reacting to the US dollar. They are reacting to treasury yields. They are reacting to inflation. They are reacting to geopolitical risk. They are also reacting to physical demand and investor positioning. Recent market data shows that gold has remained strongly supported even while short-term volatility has increased. Gold futures recently traded around the mid-$4,400 area, and gold has gained more than 10% during the month according to recent market coverage. Silver has also remained one of the most volatile major commodities in the market. And that brings us directly to the headline. Silver surged sharply. Gold moved with it. The market immediately started asking whether the Federal Reserve is trapped. That phrase sounds dramatic, but there is a real economic argument behind it. The Fed has a problem because inflation has not completely disappeared. At the same time, the labor market has shown signs of weakness. Recent July data showed U.S. consumer inflation at 3.4% year over year. Core inflation was 2.5%. That is still above the Federal Reserve target. Yet other economic data has been softer. Job growth has weakened. Retail spending has slowed. Producer prices were flat in July. That combination creates a difficult policy environment. Think about what happens if the Fed raises rates. Higher rates can support the US dollar. Higher rates can push Treasury yields higher. Higher yields can make non-yielding assets such as gold and silver less attractive in the short term. A stronger dollar can also create pressure on metals because precious metals are priced in dollars. But now think about the opposite situation. What happens if the economy weakens further and the Fed decides it cannot raise rates? Then markets may begin pricing a more supportive monetary environment. Treasury yields could fall. The dollar could weaken. Investors could look for alternative stores of value. Gold could benefit. Silver could benefit even more if investors begin moving into higher beta precious metals. This is the trap. The Fed needs to control inflation, but aggressive tightening could damage growth. The Fed needs to protect economic stability, but easing too quickly could allow inflation to remain elevated. That is why the next few months could become extremely important for precious metals. The Federal Reserve currently has its policy rate around the 3.50% to 3.75% range. A recent Reuters economist survey found that a strong majority of economists expect the Fed to hold rates through the end of the year. At the same time, the market remains focused on upcoming inflation data and labor data because those numbers could change the policy debate. And there is another important date. The Federal Reserve is scheduled to release the minutes from its July meeting on August 19th. That means traders are looking directly at the next major clue about the internal debate inside the central bank. The September 15th and 16th meeting will then become the next major policy event. This is why a Tuesday move in silver can become much more important than a single trading session. Markets are forward-looking. Traders do not wait for the Fed to announce a decision before positioning. They try to predict what the Fed will do. That is where silver becomes extremely interesting. Silver has historically been more volatile than gold. When the precious metals sector becomes bullish, silver can accelerate much faster. When the sector becomes bearish, silver can fall much faster too. That volatility comes from the structure of the silver market. Silver is both a monetary metal and an industrial metal. It is used in electronics. It is used in solar technology. It is used in electrical systems. It is used in advanced manufacturing. It is also held as an investment asset. That creates two sources of demand. One side comes from investors, the other side comes from industry. If monetary demand increases while industrial demand remains strong, then the pressure on available silver can become significant. This is one reason why silver can surprise investors. Gold has enormous value in a relatively small physical quantity. Silver has a much broader industrial footprint. That means an economic recovery can support silver demand even when gold is moving for monetary reasons. Now add a weaker dollar to the equation. If the dollar declines, then commodities priced in dollars can become more attractive to international buyers. A weaker dollar can also increase the appeal of hard assets for investors concerned about currency purchasing power. This does not mean every dollar decline automatically creates a silver rally. Markets are never that simple. But when several forces line up at the same time, the effect can become powerful. Imagine a situation where the dollar weakens. Imagine Treasury yields decline. Imagine investors begin expecting easier Fed policy. Imagine industrial silver demand stays strong. Imagine physical supply remains tight. Then silver has several potential catalysts working in the same direction. That is the kind of environment where an 11% move can happen. And this is where investors need to be careful. A large move does not automatically mean that silver will continue rising every day. In fact, the opposite can happen. After a major surge, traders often take profits. Short-term traders may sell, leveraged positions may be reduced, technical indicators can become overheated. That can create sharp pullbacks even inside a major bullish trend. Recent market coverage shows exactly why caution is important. Gold and silver have experienced strong rebounds during August, but analysts have also warned that the rally can remain volatile rather than move straight back to previous records. So the question is not whether silver can go higher. It clearly can. The question is whether the fundamental environment can support the next major leg. And that brings us back to the Fed. The Federal Reserve has spent years trying to bring inflation back toward its 2% goal, yet inflation remains above target. Recent CPI data showed some cooling, but not enough to declare victory. At the same time, the labor market has become less convincing. This creates a policy dilemma. If the Fed stays restrictive, then growth could weaken. If the Fed eases, then inflation could remain elevated. If the Fed raises rates, then financial conditions become tighter. If the Fed cuts rates, then the dollar and bond yields could respond. Every choice carries a risk. That is why investors sometimes describe this kind of environment as a monetary policy trap, and precious metals can become a direct expression of that uncertainty. Gold is usually the first metal investors watch. Gold has already shown strong resilience. Recent market reports have pointed to continued investor demand and strong central bank buying as important support for gold. China has also remained a focus for analysts watching central bank demand. But silver is the metal that can create the biggest surprise. Why? Because silver can move from being viewed as a secondary precious metal to being viewed as a major monetary and industrial asset. When that transition happens, investor psychology can change quickly. Think about the gold to silver ratio. This ratio tells us how many ounces of silver are equivalent in value to 1 ounce of gold. When the ratio falls, it means silver is outperforming gold. When the ratio rises, it means gold is outperforming silver. A falling ratio during a precious metals rally can be an important signal. It tells us that investors are moving beyond defensive gold and toward higher beta silver. This is exactly why silver investors watch the ratio so closely. The ratio is not a magic prediction tool, but it can help us understand relative momentum. If gold remains strong while silver begins accelerating, then the ratio can fall quickly. And when that happens, the silver narrative can become much louder. That can attract momentum traders, it can attract retail investors, it can attract funds, it can attract industrial hedging demand. Then the move can become self-reinforcing for a period of time. But there is another side to the story. Silver is not guaranteed to rise just because gold is strong. A stronger dollar can pressure both metals. Higher real yields can pressure both metals. A hawkish Fed can create short-term selling. A sudden reduction in geopolitical risk can reduce safe haven demand. A sharp economic slowdown can also hurt industrial silver demand. This is why the best approach is to watch several signals at the same time. Watch the dollar. Watch Treasury yields. Watch inflation. Watch Fed expectations. Watch gold. Watch silver, watch the gold to silver ratio, and watch physical demand. The market is currently giving us mixed signals. Gold remains supported by investor demand and central bank buying. Silver remains highly volatile. Inflation has cooled somewhat but remains above target. The labor market has weakened. The Fed remains cautious. Oil prices are also creating another problem because higher energy costs can put upward pressure on inflation. Recent market coverage noted that rising oil prices and higher Treasury yields were weighing on gold even as the broader monthly trend remained strong. That is an important lesson. Precious metals can rally even when the headlines are not perfectly bullish. Markets price expectations. They do not simply react to today's number. If traders believe inflation will eventually fall, then they may start pricing easier policy before the Fed actually cuts. If traders believe the economy is weakening, then they may buy gold and silver before the weakness becomes obvious. If traders believe the dollar is entering a weaker phase, then commodities can receive additional support. This is why the next Fed communication matters so much. The July meeting minutes arrive on August 19th. Those minutes could show how divided policymakers are. They could show stronger concern about inflation. They could show stronger concern about employment. They could show that policymakers are comfortable waiting, or they could reveal a deeper disagreement. Any of those outcomes can move markets, and silver may react more aggressively than gold. That is because silver is a smaller and more volatile market. A relatively modest change in investor demand can produce a much larger price reaction. This is also why investors should not chase a vertical move blindly. If silver has already jumped sharply, then a pullback would not necessarily invalidate the bullish story. Markets breathe, prices move higher, then prices consolidate, then prices move again. The most dangerous mistake is assuming that every green candle means the market must continue higher. The second most dangerous mistake is assuming that every pullback means the bull trend is over. Neither assumption is reliable. What matters is the structure underneath the move. If silver holds higher lows, then bullish momentum remains intact. If gold continues holding important support, then the broader precious metals trend remains constructive. If the dollar weakens while yields decline, then the environment becomes more supportive. If silver demand continues expanding, then the industrial story remains powerful. And if investors continue increasing exposure to precious metals, then momentum can remain strong. There is also a psychological element. Silver has spent years being treated as the cheaper cousin of gold. But when silver starts outperforming gold, that perception can change. Investors begin asking a different question. Instead of asking whether silver can catch gold, they start asking how far silver can run. That psychological shift can be powerful. It can create a new cycle of interest. We have seen this type of behavior in other commodity markets. The early move is driven by fundamentals. The middle move is driven by momentum. The late move can be driven by fear of missing out. That final phase is where volatility becomes extreme. So if you are watching silver after an 11% surge, the most important thing is not the headline number. Look underneath it. Ask what happened to the dollar. Ask what happened to Treasury yields. Ask what happened to gold. Ask whether silver volume increased. Ask whether the move was supported by futures positioning. Ask whether physical demand is improving. Ask whether industrial demand remains strong. Ask what traders expect from the Fed. Those questions can tell you much more than a single percentage gain. And there is one more factor that deserves attention: debt. The United States continues to carry an enormous debt burden. That does not mean a crisis is guaranteed, but it does mean monetary policy becomes more complicated when debt servicing costs are high. Higher rates can make debt more expensive to service. Lower rates can reduce that pressure, but may create concerns about inflation and financial stability. This is another reason why markets pay so much attention to the Fed. Interest rates are not just about mortgages. They affect government borrowing, they affect corporate borrowing, they affect asset valuations, they affect the dollar, they affect gold, they affect silver. Everything is connected. And when investors start questioning how long restrictive monetary policy can remain in place, the appeal of hard assets can increase. That is why gold and silver remain important in the current environment. But remember this: precious metals are not a guaranteed trade. Silver can fall 20% after a major rally, gold can experience deep corrections, the dollar can suddenly reverse, the Fed can surprise markets. Geopolitical developments can change sentiment overnight. That is why risk management matters. The goal is not to predict every single candle. The goal is to understand the forces that can drive the next major trend. Right now, those forces are unusually interesting. Inflation is above target. The labor market has weakened. The Fed is divided over the best path. Treasury yields remain important. The dollar remains critical. Gold remains strong. Silver remains highly volatile. And the market is waiting for more information. The Federal Reserve's upcoming minutes are therefore one of the next major events to watch. If the minutes sound more hawkish than expected, then silver could face short-term pressure. If the minutes sound more cautious, then the market could interpret that as supportive for precious metals. If economic data continues weakening while inflation remains manageable, then the argument for eventual easing becomes stronger. That would potentially create a powerful environment for gold, and potentially an even more powerful environment for silver, because silver does not need the Fed to become aggressively dovish to perform well. It simply needs the market to believe that monetary pressure is no longer getting stronger. That difference matters. A pause can be bullish. A slowdown in tightening can be bullish. A decline in yields can be bullish. A weaker dollar can be bullish. And improving industrial demand can add another layer of support. This is why the silver story is bigger than one Tuesday. It is bigger than one 11% move. The real story is whether the market is entering a new phase where monetary expectations and industrial demand begin pushing silver in the same direction. If that happens, then silver could become one of the most explosive assets in the precious metals complex. But investors should also remember that the higher the price climbs, the more volatility can increase. Do not confuse volatility with certainty. Do not confuse a bullish setup with a guaranteed outcome. And do not let a dramatic headline replace proper analysis. Watch the data, watch the Fed, watch the dollar, watch yields, watch gold, watch silver. And most importantly, watch how silver behaves when the market receives bad news. That can be one of the strongest signals. If silver starts falling less on bearish news, then buyers may be getting stronger. If silver starts rising on neutral news, then momentum may be building. If silver starts outperforming gold during periods of market stress, then investors may be moving into a new phase of precious metals demand. That is what makes this market so fascinating. Gold is telling us that investors still want protection. Silver may be telling us that investors want protection plus growth. That combination can create powerful momentum. So what happens next? The most likely answer is volatility. Silver could continue higher. Silver could consolidate. Silver could experience a sharp pullback before another attempt higher. Gold could continue acting as the anchor for the sector. The Fed could remain cautious. The dollar could determine the short-term direction. And the August 19th minutes could give traders another major piece of information. The key is to focus on confirmation rather than excitement. If silver holds its breakout structure, then the bullish case becomes stronger. If the gold to silver ratio continues falling, then silver leadership becomes stronger. If the dollar weakens, then precious metals could receive another tailwind. If treasury yields decline, then the opportunity cost of holding metals could fall. If inflation remains elevated while economic growth weakens, then the Fed could face an increasingly difficult decision. And that is the real reason behind the phrase "the Fed is trapped." It is not because the Federal Reserve has no options. It is because every option has a cost. Raise rates and risk more economic weakness. Hold rates and risk persistent inflation. Cut rates and risk renewed inflation pressure. That is a difficult triangle. And precious metals thrive when uncertainty around that triangle increases. So if you are watching silver today, do not just ask whether it can go up another 11%. Ask whether the underlying forces are changing. Ask whether the market is beginning to price a new monetary cycle. Ask whether silver is becoming more important as both an industrial material and a monetary asset. Ask whether gold is confirming the move, and ask whether the Fed can actually control the next phase of inflation without damaging the economy. Those are the questions that matter. The headline is exciting, the 11% move is exciting, but the bigger story is the potential shift underneath the price. Silver is no longer simply following gold. Silver is becoming its own story. And if the current forces continue to align, then this could become a much larger precious metals event. For everyone watching silver and gold watch, the next few sessions could be extremely important. Keep your eyes on the Federal Reserve minutes. Keep your eyes on the US dollar. Keep your eyes on Treasury yields. Keep your eyes on gold. And keep your eyes especially close on silver. Because if silver continues to outperform while gold remains strong, then the market may be telling us something very important. The precious metals cycle may be entering a new phase. And the biggest moves often begin before the majority of investors realize what is happening. If you found this analysis useful, then make sure you like this video and subscribe to Silver and Gold Watch. I want to know what you think. Do you believe silver can continue this explosive move? Do you think the Federal Reserve is trapped between inflation and a weakening economy? And do you think silver will outperform gold from here? Leave your answer in the comments. The next move could be very important, and we will be watching it together.